Hi, welcome back, and this quick video update will talk about if will gold hedge against as inflation. So let's go. This article is made by the World Gold Council on February of 2022. The article is Beyond CPI, Gold as Strategic Inflation Hedge. And spoiler alert, gold is not a hedge against inflation or deflation. You see, this is a chart explaining the relationship between gold returns and the CPI returns year over year, and you see all the gray dots. The line in the middle would be a perfect match between gold returns and inflation, and you see all the gray dots that gold mostly will not move like inflation. So gold is something else. This is the lost decade of gold. If you check the chart here, you will see that after the crisis of Lehman Brothers, you see people hoarding gold and a crash, and all this area here gold went down with inflation moving between 1 and 2% according to official US statistics. The inflation was going up, but the price of gold went down. Also, if you take this chart will change if you need to change the base of the prices of gold. But here in the 80s, at the beginning of the 80s, at the end of the 70s, sorry, we have a peak price of gold adjusted by inflation, and then we have more than 30 years of the price of gold going down adjusted by inflation. So this is using again the United States inflation. So gold tries to follow inflation, but there is this noise moment in history where gold for years won't follow inflation. And we also not cover you from deflation because you may be hammered by the deflation that happened after the Lehman Brothers. It was a deflationary collapse and gold went down all the way. So there is no real hedge. This is a YouTube stream. This is a report by the US government, the Office of Controller of the Currency. I was watching a live stream on YouTube by Gold Silver Pros, which is a gold silver guru. He was playing this quarterly report, and this report shows all the exposure the banks have to precious metals derivatives. So this is the quarterly report on bank trading and derivatives activities. If you see here, it's very alarming. For the first time, the banks in the United States have an exposure on $500 billion, more than $500 billion, around $500 billion US dollars. This is in 2022, and the number means that on the first quarter of 2022, the exposure of banks to precious metal moved almost $500 billion, with a maturity of less than a year. It means that there will be huge volatility of the banks. Banks are betting against, banks are exposed to precious metals, and this is very important because the exposure is huge. So let's continue with that. I expect huge volatility in the precious metals. If the bank are so exposed, they should do something with this derivatives portfolio, and something big should happen. So we are only half of the pain, because we are in a scenario of interest rates going up hugely, and let me show you that the Federal Reserve is in a quantitative tightening cycle, and we went from 0 up to here. We went for 0 and now we are around 1%, and we should go all the way to 3% this year to chase inflation, which is above this chart, above 8%. So this chart is not. So this is all negative territory, and the Fed should continue to go up and increase the interest rates, like they are going to make a new hike, a rate hike on July next month. So they will continue to increase rates to stop inflation, because they are risking their reputation and they must fight inflation as one of their main mandates. This movement in the rate hikes has brought down multiple asset classes: crypto, precious metals, and the stock market, and we are half the way in this rate cycle. So you see the prices and the charts in gold. The gold monthly charts are with 3 consecutive monthly charts that are bearish, and it looks like gold is fighting to stay above 1800 with all this information. In the next chart I will show you that we have a collapse in the Japanese yen against the US dollar. So the complete bond market is at extreme high risk. We are seeing a complete collapse of multiple assets. We are half the way. So the central banks are forced to remove all the way down, or remove all the liquidity, because they are deep in negative territory, and all the markets are extremely leveraged. And Bitcoin crashed with only a half of the movement of the rate hike cycle. You see the complete clash of Bitcoin, which is very limited supply, and nothing happened with Bitcoin, and completely failed as a hedge against inflation or deflation with its limited supply. Is this a temporary movement? Maybe we will see a temporary deflationary knee-jerk reaction in the market, and then we go all the way up again, and we enter in deep stagflation and the recovery and reflationary pressures. That could be one scenario. I'm not sure. It depends on the politics. If they stop what they're doing and stop chasing inflation, we have crazy inflation. If they leave the markets this way, we will have a initial reaction, and we're going to go down on mostly all the precious metals, and we are only half the way. So the conclusion for me is gold is not a hedge against inflation or deflation, a trading vehicle against governments. This is the best definition for gold, and it was made by one of my mentors, a real good expert. This is the best definition I found for gold. Gold is a trading vehicle. The good thing about gold, which is there is no counterparty risk. You have gold. If you hold gold, that's not a credit. That's not paper. That's a real tangible asset, and you don't have counterparty risk. And that is the good thing. The bad thing is that it's proven that gold is not a real hedge against inflation or deflation, but it's an insurance against systemic collapse or systemic risk. So that's why most of the central banks own a bit of their reserves in gold. And this is the end of the presentation. If you want to know more, please subscribe. I have all the weekly content, and the address is right there. Thank you very much.